Hi, everybody. This is Stephen Mnuchin. I'd like to call this meeting of the Council to order. Thank you for joining today's meeting. I believe we have all 15 of the Council members on the phone. Today we have two items to cover. First, we'll hear a presentation and vote on the Council's 2020 annual report. We'll then vote on the minutes of our last meeting. If I could just please ask everybody to make sure you mute your line when you're not speaking, that would be terrific. So on the first item, I'm pleased to vote today on the Council's 2020 annual report. The annual report is the result of extensive analysis and collaboration across all of the Council members' agencies. It provides our comprehensive assessment for the public of the Council's view of potential risks across the financial system. It also includes recommendations for regulators, Congress, and market participants. This report has a particular focus on the effects of the COVID-19 pandemic on the financial system and the economy. It also addresses in detail the forceful steps that financial regulators have taken to respond to the crisis. I want to thank the members of the Council and their staffs for their hard work preparing this year's report and for their ongoing efforts to make the financial system stronger and more resilient. Let me now turn it over to Howard Adler and Stephen Ledbetter from the Treasury Department, who will provide an overview of the report's findings and recommendations.
Thank you, Mr. Secretary. FSOC was created by Dodd-Frank after the Great Recession. While the Council has issued an annual report each year since then, this is the first annual report we have actually written during a period of financial stress, that emanating from the COVID-19 crisis. As always, the report discusses significant financial markets and regulatory developments, potential emerging threats to U.S. financial stability, recommendations to promote U.S. financial stability, and the activities of the Council. As a result of the financial stress caused by the pandemic, however, there was more to be said about many of the items covered in the report this year, resulting in this year's report being about a third longer than last year's, and in the discussion of vulnerabilities, recommendations, and the areas we have highlighted by putting them in boxes being more robust than in past reports. The financial stress caused by COVID-19 is a theme in this year's annual report that carries through from the executive summary through the discussion of each financial sector of the economy. Another recurrent theme in the report is the extraordinary efforts taken by the federal government, perhaps most notably by Treasury and the Federal Reserve, but also by each other FSOC member agency, to combat the financial impacts of the pandemic and the dramatic ameliorative impacts that these efforts have had on financial stress in the economy. The important role of FSOC in ensuring that throughout the pandemic, significant financial data and information was rapidly shared among FSOC member agencies is also noted. I will now turn it over to Steve Ledbetter, FSOC's Executive Director, to discuss the annual report in more detail.
Thank you, Howard. As the Secretary and Howard have noted, this year's report considers risks to financial stability in the context of the extraordinary shock to the U.S. financial system due to the onset of the COVID-19 pandemic. Prior to the pandemic, the U.S. economy was in the midst of a long-lived economic expansion with very low levels of unemployment. The global pandemic led to an unprecedented contraction of economic activity, with the unemployment rate peaking at nearly 15% in April. Since then, extraordinary measures undertaken by policymakers have succeeded in stabilizing markets, arresting the decline in economic conditions, initiating a recovery, and substantially lowering the unemployment rate. At the onset of the pandemic and throughout the year, the Council provided an important venue for facilitating coordination and analysis of risks across member agencies. Council members regularly identified key risks and shared information regarding their policy responses. We also increased the frequency of staff-level meetings to allow important analyses of major market developments to be shared in a timely manner with all Council member agencies. In addition, the Council's previous identification of vulnerabilities and analyses of risks leading up to the financial stress helped ensure that policymakers' responses were more coordinated, well-informed, and effective. As the report indicates, though policy actions to minimize the effects of the pandemic have been effective, risks to U.S. financial stability remain elevated compared to last year, largely due to remaining uncertainty regarding the severity and duration of the pandemic and its potential impact on financial markets and the U.S. economy. I'll spend the next few minutes highlighting 5 of the key topics raised in this year's report. First, short-term wholesale funding markets. The report notes that stresses on prime and tax-exempt money funds in March revealed the continued existence of structural vulnerabilities, leading to increased redemptions. The report also discusses how liquidity demand from leveraged participants, such as hedge funds using Treasury collateral and mortgage real estate investment trusts using agency MBS collateral, may have contributed to repo market volatility. The report recommends that regulators review these structural vulnerabilities, including the vulnerability of large-scale redemptions in prime and tax-exempt money market funds, and the role leveraged non-bank entities may have played in the repo market. The Council also recommends that, if warranted, regulators take appropriate measures to mitigate these vulnerabilities. The report also includes an in-depth analysis of how the activity in March exposed fragilities in the Treasury markets. Factors that likely contributed to the market dislocations include massive selling by real and levered investors, dealer balance sheet and risk management constraints, and the rapid decline in liquidity provisioning by principal trading firms. While the Federal Reserve's actions restored market functioning, the report notes the need for further study of these issues. A second issue discussed in the report is the level of borrowing and leverage by non-financial businesses. The corporate debt to gross domestic product ratio was at historic highs when the pandemic hit the United States. Economic activity contracted in March, causing concerns about the sustainability of corporate debt. Since then, despite the initial turmoil in credit markets, the policy-aided rebound in business financing has been strong. As a result, the corporate debt to GDP ratio has reached new record highs. The report notes the increase in non-financial corporate debt that has been downgraded since March, as well as the increased default rates on leveraged loans and corporate bonds, and notes the potential vulnerability of businesses with weakened balance sheets if, for example, there were a major repricing of risk that negatively impacted liquidity, increased borrowing costs, and heightened rollover risk. The report therefore makes a number of recommendations, including that agencies continue to monitor levels of non-financial business leverage, trends in asset valuations, and potential implications for the entities they regulate in order to assess and reinforce the ability of the financial sector to manage severe simultaneous losses. A third issue discussed in the report is the adverse impact of COVID-19 on several components of the commercial real estate market, including the hotel, retail, and office segments. The report discusses the potential for a prolonged downturn to leave the CRE sector vulnerable to mortgage defaults and declines in valuations, with potential spillovers to the broader economy. The report therefore includes a number of recommendations, including that regulators continue to monitor closely the performance of CRE loans, volatility in CRE asset valuations, and the level of CRE concentration at banks and other entities that hold CRE loans. The fourth issue discussed in the report is the performance of large bank holding companies through the pandemic. The report discusses the potential for financial distress at large, complex, interconnected bank holding companies to affect financial markets and the broader economy, but notes that the banking system has been able to withstand the financial fallout of the pandemic, in part because of the stronger capital and liquidity positions built up over the last decade. The report also notes that large bank holding companies have benefited from the extraordinary policy measures and other supervisory and regulatory relief provided under these exigent circumstances. The report therefore emphasizes the importance of continued vigilance regarding the resilience of large bank holding companies and makes a number of recommendations, including that financial regulators ensure that the largest financial institutions maintain sufficient capital and liquidity to ensure their resiliency. The fifth and last issue I wanted to highlight is cybersecurity risk. The report highlights the potential for the pandemic to further accelerate financial institutions' reliance on technology and third-party service providers through increased use of teleworking systems and dual work locations. The report notes that while greater use of technology can provide significant benefits in terms of reduced costs and increased efficiency and resiliency, it can also potentially increase the risk that institutions experience a severe cybersecurity event. The report thus includes a number of recommendations, including that federal and state agencies continue to monitor cybersecurity risks and conduct cybersecurity examinations of financial institutions and financial infrastructures to ensure, among other things, robust and comprehensive cybersecurity monitoring, especially in light of new risks posed by the pandemic. To conclude, I would note that the development of this report was truly a collaborative effort among all of the Council members and member agencies, and it provides a clear view into the Council's identification of potential risks or vulnerabilities, highlights key actions taken, and makes additional recommendations for addressing these risks. Be happy to take any questions.
Great. Thank you very much. Do we have any questions for either of them? Okay, if not, I know that some of the council members would like to say a few words about our efforts. So, Chair Powell, I'll start and turn it over to you, please.
Thank you, Mr. Secretary, and also thank you, Howard and Steve, for that excellent presentation. This year's annual report is a particularly significant one, and I'm happy to support its publication. It was produced under extraordinary pressures this year, and I want to commend the staff who worked to make that happen. So Steve just provided an excellent detailed analysis of the principal recommendations and analysis and conclusions in the report, and I won't repeat that. I will simply say that it is a careful, thoughtful analysis and does include a robust set of recommendations. So this annual report is a testament as well to the cooperation and coordination among the organizations represented here today and to the standard of excellence each maintains in pursuing the FSOC's mission. It's been a long and difficult year, but the efforts of each of our staffs have helped mitigate the fallout. So I want to thank everyone for your dedication and their work in service to the public. Thank you.
Thank you very much. Chairman Clayton?
Thank you, Mr. Secretary. I'll comment on two matters and agree with everything that Chairman Powell just said. With respect to the report, this is a comprehensive and nuanced assessment of the recent period of financial stress. And it's a real credit to the authors, as well as, and I want to emphasize this, the deep cooperation and engagement among the staff of the FSOC member organizations throughout this year and prior to this year. And it's just gratifying to see the women and men of the various agencies work so seamlessly and supporting each other enthusiastically. I also want to make another comment. This will be my last meeting as a member of the council, and I want to thank all the council members for their diligence, dedication, and service to the American people, including during this most recent difficult time. The collaboration and close engagement of council members in this virtual room we have today has not only benefited the work at the SEC, but I believe it did ensure more broadly that the economic effects of COVID-19 were proactively assessed and addressed promptly to the benefit of our nation and its people. And as always, I'd be remiss if I didn't single out the actions of the Federal Reserve and the Treasury initially and then through the CARES Act. You were prescient, bold, extremely effective. And with that, I just want to thank each of the council members on a personal and professional level for the support you've shown me and the SEC over the past 3.5 years. Thank you, Mr. Secretary.
Thank you very much. Director Calabria?
Thank you, Mr. Chairman, and let me thank Chairman Clayton for his service. While I'm not sure how many more meetings I'll have, I'll say it's been a delight and a pleasure working with you and your team at the SEC, and I certainly hope to continue that engagement in the future. Let me also echo the support of the staff. Really has been a tremendous effort. I know a lot of work went into this. I just want to highlight one issue, which is, I think as the committee is aware, 2 weeks ago, we finalized our safety and soundness regulatory rule in the efforts at the FSOC in the discussion of the statement released in the last meeting on our activity-based review of the secondary mortgage market were very much appreciated. I believe this review was necessary. It was important. I think it's an important step in reforming our mortgage finance system. I hope the committee feels that we did incorporate suggestions that were made from that review into our final rule. I share the council's overall view that risk-based capital and leverage ratio requirements materially less than those in the rule would likely not adequately mitigate potential stability risks posed by the enterprises. And I commend the council's commitment to monitoring the activities of Fannie and Freddie and our implementation of the regulatory framework to ensure that these risks to financial stability are appropriately addressed. We welcome it. And again, thank you, Mr. Chairman, and I again thank the work of all of the staff.
Thank you. Chairman Tarbert, please.
Thank you very much, Mr. Secretary. I am pleased to vote in favor of this year's annual report. As the report notes, COVID-19 was an extraordinary shock to the global financial system and led to substantial financial stress. But importantly, it didn't lead to a financial crisis. During this real-world, real-time test of the resilience of our markets, our market participants, and our regulatory agencies, All three performed exceptionally well. Of course, we can't take a victory lap. Risks to U.S. financial stability remain, and the magnitude of those risks is tied at least in part to the severity and duration of the ongoing pandemic. Our annual report describes and assesses those risks individually and in the aggregate. I congratulate the FSOC team for an excellent work product. I'd also like to recognize the outstanding leadership of you, Mr. Secretary, as our chair, and thank our other my other FSOC colleagues for their partnership, especially as we've developed a comprehensive response to the pandemic. When things got challenging earlier this year, we pulled together, worked together, and made sure our financial system held together. The American people deserve nothing less from us, and I was pleased to be a part of it. Thank you so much.
Thank you very much. Chairman McWilliams?
Thank you, Mr. Secretary. I echo the comments thanking the staff for this significant effort on the FSOC 2020 report. As noted, it differs from its predecessors and with good reason. I would note that from the FDIC's perspective, I have been impressed with the resilience of our banking system and the way banks responded to the needs of their customers. At the very onset of the pandemic and resulting economic shutdowns, banks had to figure out how to operate in this new world with limits on physical movement while making sure much-needed liquidity was available to the businesses and customers who needed it. We all remembered the 2008 crisis and the credit crunch all too well. In this regard, I'm pleased to report that insured institutions have served and continue to serve as a source of strength to the economy and their communities. The just-released FDIC quarterly banking profile for the third quarter reflects that overall banks are holding up well with strong capital and liquidity, relatively low loan delinquencies, and recovering earnings. But as described within FSOC's annual report, we remain vigilant, particularly but not exclusively, for knock-on effects in the commercial real estate sector. We continue to monitor with our fellow regulators a number of community and regional banks with CRE concentrations. It is important to point out that the composition of the industry's CRE holdings is different today than in the last crisis. Aggregate concentrations are lower than before 2008 crisis, particularly for acquisition, development, and construction loans. There are also some subsectors that are now struggling due to the pandemic that did not warrant heightened regulatory scrutiny before the pandemic, namely hotel and leisure businesses. It is prudent to remember that even within specific subsectors, CRE is not monolithic. There are great variations based on types of property and among markets. We continue to urge banks to work with their borrowers and confirm that they have significant flexibility to do so. We have been intensely focused over the past several years through our examination program on underwriting and the risk management practices for institutions that are concentrated in CRE, and will continue to do so as the effects of this pandemic unfold. Thank you again, Mr. Secretary and FSOC staff, for an excellent report and a productive collaboration in the report's preparation. It has been a tremendous honor to serve with all of you on the Council. And Mr. Secretary, I would like to thank you for your service to the country. Thank you.
Thank you very much. Acting Controller Brooks, please.
Thank you, Mr. Secretary, and I want to echo my colleagues' thanks to you and to Chairman Clayton for your extraordinary leadership on behalf of the country, which I think is reflected in today's FSOC annual report. Like everyone else here, I support issuance of the FSOC's annual report and the recommendations set forth there. I thank the FSOC staff and the staff of the other agencies for their hard work on this report and believe that the FSOC's recommendations strengthen the progress we've already made to enhance risk management and prudential controls in the financial system. I'm particularly supportive of the report's treatment of innovation. Financial innovation offers considerable benefits to consumers and providers of financial services by reducing costs, increasing the convenience of payments and other services, and potentially increasing credit availability. Innovation can also create new risks that need to be understood. Such risks underscore the need for the development of oversight standards, appropriate regulation, and U.S. leadership. Some nations have begun exploring or using central bank digital currencies, for example, to enhance the global standing of their currencies and enable faster payments. Likewise, several nations have begun assessing whether and how privately issued stablecoins may facilitate faster and more efficient payments, provided that such activities are subject to appropriate regulation and oversight. Against this backdrop, it is important that U.S. regulators adopt an approach to digital assets that will provide for responsible innovation in a manner that is safe, fair, and compliant with all applicable laws. Providing clear guidance, as the FSOC has done, will accelerate the development of a 21st century financial system that is consistent with the changing needs of institutions and consumers within the U.S. and that is globally competitive. Thank you.
Thank you very much. Director Craninger, please.
Thank you, Mr. Secretary, for calling this meeting of the FSOC and for your capable leadership of the FSOC during what has been an incredibly challenging time for the nation. Certainly the pandemic and its economic effects posed and continue to pose a challenge to the financial stability of the United States. Individually and together through the FSOC, our agencies have risen to that challenge, and I, too, am very proud of the work that we have done together and appreciative of all of my colleagues. The FSOC annual report we are considering today describes in detail what occurred and what we have collectively done to support financial stability and to carry out our respective missions. I enthusiastically support the issuance of the annual report, and I'd like to briefly highlight some of the CFPB's efforts described in it. Certainly, first and foremost, the Bureau is engaged in extensive consumer outreach to ensure that consumers understand their rights and the options that they have, particularly afforded under the CARES Act and many of the provisions and actions that have been taken. We've rapidly produced a series of tools, just dozens of blogs and web pages, videos on pandemic-related consumer education materials in multiple languages. We worked extensively with partners across the nation to get that information out and into the hands of consumers, to continually update it on a variety of topics: mortgage, credit reporting, debt collection, student loans, frauds and scams, and countering those efforts. In particular, in the area of housing, we launched a federal interagency housing website with the Department of Housing and Urban Development and in partnership with the Federal Housing Finance Agency. And that's to inform consumers who are concerned about how they will pay their mortgage or rent and about the relief options available to them. In just over 6 months, nearly 4 million users accessed those pandemic-specific resources on our website. The annual report provides yet another resource for those interested in the pandemic impact and the official response. In particular, the Bureau appreciates the discussion of household finance in Section 3 and of consumer protection in Section 4. Finally, given their importance to both consumers and to broader financial stability, the Bureau fully supports the Council's recommendation for the official sector to take additional steps to coordinate, collect, and share data and information, identify and address potential risks, and strengthen the oversight of non-bank companies involved in the origination and servicing of residential mortgages. As we continue to recover from the pandemic, the Bureau stands ready to support consumers and remains committed to its important mission. Thank you again, Mr. Secretary, and all of my colleagues.
Thank you very much. Chairman Hood.
Thank you, Mr. Secretary. I am pleased to support the FSOC's 2020 annual report, which addresses risks to the financial system and how the agencies of this body have mitigated these risks before and during the COVID-19 pandemic. When the pandemic began, all the agencies assembled here acted decisively to ensure continued financial stability. Using our existing authority and those provided in the CARES Act, our agencies continue this vital work today. As noted in the annual report, the credit union system continues to serve its members and provide much-needed capital to families and small businesses. Well capitalized, the credit union system has a net worth ratio of 10.5% and $1.75 trillion in assets, as well as ample liquidity, following the statutory enhancements made to the Central Liquidity Facility. While challenges indeed remain, credit unions are well positioned to support our nation's economic recovery post-pandemic. Finally, I wish to thank you, Mr. Chairman, and the FSOC's talented staff for fostering a collaborative environment over the years and during this challenging period. I have been honored to serve with you, sir, and the members of this council. Thank you.
Thank you very much. And I, too, want to thank all the members of the council for all the hard work this year, and I also want to specifically thank all the staff of the different agencies for all the work in getting this done. So now I'd like to call for a motion. Is there a motion to approve the resolution approving the council's 2020 annual report?
So moved.
Is there a second?
Second.
Second.
All in favor, say aye.
Aye.
Any opposed? Thank you. The resolution is approved. Okay, Also look for a motion on the minutes. Do we have a motion to move forward on the minutes?
So moved. So moved.
Do we have a second?
Second.
All in favor?
Aye.
Aye.
Terrific. Any opposed? Great. Is there any other business that any of the council members would like to address?
Mr. Secretary, this is Tom Workman. I just wanted to put in a quick word of expressing my thanks to you for your dedicated service as the Secretary of the Treasury and as Chairman of the Council. I've appreciated the opportunity to work with you.
Thank you very much. I appreciate those kind words. Okay, if there is no other business, do we have a motion to adjourn?
So moved.
Do we have a second?
Second.
All in favor?
Aye.
Aye.
Terrific. The meeting is adjourned. Thank you all for your great work. Have a great day. Bye.